Okay, start again. Here we go. Today, we're going to do just the very end of chapter 13. We're going to start chapter 12. We're on spring break when we get out of here, except for tomorrow. But for this class, we're on spring break. There's no homework during spring break. That's the good news. As soon as we get back, though, we're finishing chapter 12, which is stocks, and then our quiz is on Wednesday, 2 weeks from today, when we get back from vacation. In chapter 13, what I want to mention, what I didn't get to, is family of funds, because you're going to hear this phrase, especially when your retirement is going to be with a brokerage, let's say Fidelity, because I keep using that as an example. Well, when you go in, you're going to start learning little things about the different mutual funds you selected for your retirement. And one of the things you're going to look for is you're going to say, hey, how many times can I trade out of this one into that one online? And you're going to see things where it says unlimited transfers within the family of funds, limited to 6 transfers outside the family. And what they mean is, if you're transferring from one Fidelity, because you're with the company Fidelity right there, or whatever company it is, if you're transferring from one Fidelity to another Fidelity, that's within the family. And that's what they mean by unlimited, because you're transferring right within Fidelity. But if you're transferring from Fidelity Fund, and let's say this isn't your retirement, you may also own some shares in a mutual funds at another place called T. Rowe Price, which has no little mutual funds. Fidelity will let, as an example, will say, you can set up an account here, you can own some mutual funds with Fidelity, and if you want to own some mutual funds with some other brokerages, you can do it right here within Fidelity. They'll let you buy other shares from other places. And when you go to do that transfer, though, that's outside the family, and there's limits on how many you can do to another fund outside the family. So that's what in the family means and outside the family. For your retirement, almost all your choices are within a family. So there'll probably be unlimited change if you want to switch things at any time, in most cases. Or it will say this many within the family, this many outside the family. So that's what family of funds mean. We're done with chapter 13. Now, let's get to chapter 12, stocks. We're going to start with Investopedia. Here's our rankings. We know Josh, we have to subtract like some crazy number, 6,000 something. And I opened his just to show you how to recognize it. Is this, hang on, where's Josh? That was it? Okay. It's right here. It's right here. If you follow along, I gotta find it now. KNDI, he bought 750 shares. These are all his transactions, I think. Is it every single one of them, or some of them didn't use? No, that's all of them. There's 12. But notice there's no other purchase of the shares KNDI. There's those 750. He went to sell it, he had 1,500 to sell, but he only bought 750. So there's twice as many shares there, and yet it gave him the money as if 1,500 got sold, but only bought 750. So if you do the math on it, there's about 6,000, I don't know what I calculated, I have it written down. 660 or something like that. $6,660. No, we don't want to say that. $6,660 that was just given to you. Now, believe me, I've never heard of something like this happening in the real world. And I've used this for so many years. I think this has got to be the 10th year I'm using this. Never has this happened like this. I mean, this is one account after another. Gabrielle, David, you had it happen too, right? Is this yours right here?
Yeah.
Okay, so let's go to her. Here it is. She bought 30 shares of Coca-Cola and 3 shares of this, I don't know what ULTA is. Huh?
Makeup.
Makeup?
Makeup store.
Really?
Yeah.
Oh. And so that's all she's bought, 30 and 3 shares. Now look at her portfolio. She has 9 and 60 shares. Now that's crazy.
Oh, I didn't even notice that Ultra was more too.
Yeah, 3 times the amount you bought, I think.
Yeah.
Yeah, and then twice as many as you bought here. So it's just the simulation's handing money out. So I suggest you do transactions. It seems to be the only way to get this free money is to do transactions. So, and if you have not done 2 transactions for February, man, that couldn't be the most important thing about this whole thing. On the paper, such a huge percent of your grade is that you've done 2 transactions per month. You have tomorrow is the last chance to do if you have not done 2 for February. Tomorrow's it. It's the last day of the month. And today the market's closed. So So look for it. Everybody that this is happening to, when you hand in your paper, finally I go to look at everybody's portfolios and I count the transactions and make sure you did too. And I read your paper and I'm looking at your portfolio. I guess I'm gonna, for the first time ever, part of your paper is gonna be that you caught the mistakes that are taking place. And you included it in this 1 to 2 page paper. So there's not a lot of room to write a lot of stuff. Somewhere in this paper, which we're about to debate how long it is after break, you gotta fit in there the mistakes that the site's making. Because I'll see it as I'm reading your paper, I'll catch it. And so that may be part of your grade, that you can catch the mistakes that are being made on yours. What I like about, oh, you know what? I know what I want to do. Is this Sabrina's? Is this yours? Does this look like yours?
Yes. Yeah.
Does it?
I think so.
What I want to show you is, she just happened to have bought and sold almost the same amount of shares each time, which makes it real easy to see whether she made money or not. Part of your paper is where, I can't remember if it's which one made the most, which one made the least, but you have to sit there. If you sold, let's say you bought 100 shares, but then you sold 50, and then you sold 40, and then you sold 10, you got a little math to do to figure out if you really made money on it. But with hers, this column, this is the key when you're writing your paper. Because this column is telling you exactly what you spent when you bought it and exactly what you received when you sold it, and it takes the fees into consideration for you. You don't have to sit there now, am I going to add something here? Did I spend $6.99 more? Do I have to subtract $6.99 from when I got the check, how much I received? This column does that for you. So in her case, you can go right here to this one, CELG, bought 30 shares, in 2006, 37. Now you follow it up where she sold exactly 30 shares, and all I got to do is see the difference between these two numbers. Okay, you lost about $4 here because of the fees. So there's that one. By the way, this is probably the only one she lost on. The rest are all winners. She is just chipping away little bit at a little bit. And this is short-term investing at its best, because that's really a strategy of short-term investing. You find something you have a good feeling about, you said it has to go up, it goes up because you're watching, and you sell it when it does. And maybe you make $40, $50, $60, and then you do it again, and then you do it again, and then you do it again, and you just, that's how you build the portfolio. And if you're doing a short-term investing strategy, this, you guys only have a month and a half left. I don't even think you have a month and a half left. You have to use short-term strategies for this. This is what this one's all about, because you're not in it for the long run. You're not going to be in this for 30 years. You're in this for 3.5 months, and that's it. You only got like a month and a half left. So follow another one. Here she bought 12 shares. Take this number, 12 shares, this number, she made, what is that, $7, $8, $9, a little less, $8. Still, she made $8. This is after the fees, so that's chipping away. Follow another one. This is Target. Is that what that is? Mm-hmm. Target, 15 shares. Target, 15 shares. Now, she's using too little money because it's so much harder to beat the fees when you spend this little. You almost should be spending about $2,000, but she still did it. 7, 8, about $9 more. All right, after fees. You know what? Because these numbers are after the fees. Where's the next one? Is this it? CONN, 50 shares. $970. 1,018. So there's $48. Chipped away at $48 in only how many days here? 17. This one's to the 30th. So 10, 13 days. Go to the next one. Again. GDP, 77 shares. GDP, 77 shares. 1,007, 1,078. There's $71 more. Again, chip away, chip away. You buy it, you watch it, it goes up, and you sell it. You don't get greedy. And you just keep doing it. How do you find them though? How are you finding these that you make your decision to buy and then chip away with it?
Some of them, like at first it just started with like companies that like I use like Target and stuff, but then I started
Which is a great philosophy. Companies that you use, a lot of people are using also. And if you like that store or that company, a lot of other people do probably, and that's a good philosophy, and buying stock in that one. Mm-hmm. And what else? What were you going to say about some of the other ones?
Well, then I started doing like more research into it. Like on Yahoo Finance, usually there's like little news stories like underneath everything, and so I started watching those more.
There you go. Which is part of today's. I wish I had my subjects up there. I don't know why I didn't write them. I forgot about them. But part of today is, again, I'm going those who printed this, I'm going to slide, where is it? 8. Slide 8 is all about evaluating stocks, evaluating companies. And the key, if you ever decide, so one of these days you're going to be bored of your job. And you're going to go, wow, I'm making more money I've made my whole life. And, whoa, I am not spending as much as I'm making. Look at this. I got a retirement going. I got some savings going. I got some play money. And even though my neighbor got a boat and a motorcycle, I don't have to have a boat and motorcycle. I'm going to invest this money. And when you get to that point, this is exactly the kind of thing you're going to want to do, because you're going to go, wow, my coworker keeps playing the market and says they made $1,000 last night and another $1,000 the day before. So the key is research. Keep evaluating and research and watching if you're really going to do it, because as much as whatever's working for you that is allowing you to make the gains, it will all of a sudden not work for you. You've got to keep doing research and understand what the numbers mean. You're going to learn about the PE ratio, which we talked a little bit about, the beta we talked a little bit about. Go to their financials, research, and then you finally say, okay, I'm going to buy 50 shares of that or 20 shares of that. You build your own little mutual fund by buying a few shares of a bunch of different companies, and you have your own little basket then. If you use Robinhood, you don't have to pay the $6.99 fees in real life. So that's one of the subjects. In Yahoo Finance, I have also found to be one of the best places to get the information from. All right? Securities Exchange Commission, you can get more recent information a little bit, kind of harder, not as user-friendly. But Yahoo Finance has almost everything there. Some of the information is old, like the financials, but still you get a lot of good information. So that was one of the places I was going to recommend. Okay, let's go to back to slide 2. We got to talk about the difference between common and preferred shares, since we're done with Investopedia. Keep plugging away, even during break, you read a story or something like that. Again, you know what? I want to tell you, if over the night you hear about some crazy thing on the other side of the world, like Pakistan said, we had enough of you, and they send some nuclear bomb over. This could be like this could be the trigger to a crash. And so, you may want to get on, if you're pretending this is real money, you may want to get on there and start selling everything as fast as you can to beat what will eventually be a big loss for a little while, possibly. Because the market's kind of stretched, and all it will take is a trigger. Something to happen. It could be a natural disaster even. A major earthquake in California that's going to do $1 billion worth of damage. That could be the trigger that then sets the market for a downfall, possibly, 10 to 30%. This is the kind of thing that you kind of want to be aware of. And when you start having real money in the game, all of a sudden, all the news headlines from around the world become that much more important to you. And you just start to grasp a real understanding of how things on the other side of the world can easily affect you within hours from it happening, like a disaster. All right, so the difference between common and preferred, if you own common stock of a company, you're part owner of the company. Not only are you part owner of the company, but usually when big items come about that people need to make a big decision on, like who's going to be the president of our company or who's going to be the next board member on our board, every owner gets a vote. And for every share you own counts as one vote. So, if somebody, you hear about them saying, and they just got a seat on the board, it's probably because they bought so many shares that they have a huge stake in the company, and that it gave them the right to say, hey, I need to be on the board, because I own so much. And when it comes up for vote, you're going to get, if you truly get into investing and you own shares of stock for a company, you're going to get these things in the mail that says it's time for you to vote. Here's how many shares you own, here's how many votes you get, and usually the most common voting things I get, the name's slipping my mind because I'm getting so old, but is about board members whose names I never recognized. I don't know anything about them. In the old days, you couldn't do a Google search because there was no such thing as the internet yet. And so what I always used to say is I own so few shares compared to so many other people that I pick the box of staying and let those who have a whole bunch of money in this company, who usually have
your best interest in mind, because they want to make money, they want this company to grow, they want the best for this company, just like you would if you own that many shares. So I would just abstain and let their vote count that much more as to who should be on the board. Because, you know, they have millions of dollars involved, where I may only have a couple thousand. So anyway, just so you know, even if when you're in mutual funds, there's voting that takes place, and you're gonna get these in the mail. And don't ignore them, do something, get on the internet and at least abstain or whatever, because they'll send you a second one, then they'll send you a third one. That's how important, as an owner of the company, it is for you to vote. Now, preferred stock, you own nothing. You do not get voting rights. But you're more important in some ways than the common. If for any reason this company goes bankrupt, first, you know, the liabilities on the balance sheet. We owe money to our suppliers. They get their money. Now there's money left over. It goes in this order. Whoever owns bonds gets their money first. Now there's still money left over? Okay, whoever owns preferred shares gets their money. There's still a little money left over. The very last ones are the common shareholders, which are the owners. They're the last ones to get money. So preferred is before common. If you have money in the game and you own preferred shares, you have less risk. They call it less risk than common in case something happens to the company. Also, usually preferred stock will include a dividend as part of the deal. And if for any reason the company says, oh, we're having a bad year, we can't pay dividends, if they pay dividends to common shareholders as well as preferred, they have to pay dividends to preferred if they're paying common. It's kind of a law. And if they're going to pay, and let's say they stop dividends, a year or two goes by and things are a little better, and they announce they're going to do dividends again, but limited. Preferred stockholders get their dividends first before common shareholders can get dividends. So that's another advantage of owning a preferred stock. But again, you have no ownership rights, you have no voting. It's like you lend money to the company is what it's kind of like bonds in a way. But there's no maturity date on the preferred. With bonds, at least you get your money back someday when they mature. But with preferred stock, you only get your money back when you sell it to somebody else who wants to own preferred shares of that stock, which you can do through your broker really fast, just like common stock. So that's the difference. Whoops, where are we going here? We're going to slide 5. How do you make money from stock? Some of them pay dividends, not all of them. And if you own the stock in which, at the time in which there's what's called ex-dividend date, we're going to learn that after you get back from break, and they announce what day the dividends will be paid on, and you have to have owned the shares by on this date in order to get the dividend. If you didn't own it on that date, you bought it the day after, you don't get the dividend. The person who owned it before you gets it, stuff like that. But if it pays a dividend, that's one of the ways you can make money on owning stock. But really, most people make money is because they sell it at a price higher than what they paid for it. That's the most common way to make money off stock. They call it dollar appreciation. The price went up, just like the mutual fund shares. Remember, the mutual fund could possibly do dividend distributions. It could do capital gain distributions, but it's the dollar appreciation called the capital gain itself because you sold it for more than what you paid for it. The stock doesn't have capital gain distributions, but it has dividends and it has appreciation, which would be a capital gain. Remember, if a stock goes up in price and you're tempted to sell it, you always got to ask yourself the question, how am I going to be taxed on it? You must keep that in mind because there's such a huge difference, such a significant difference between how you would get taxed if you owned it for a year or less compared to if you owned it over a year. You know, in most cases, you're looking at 10 to 15 to 20% more in your pocket by just waiting past that year date before you sell it. Also, you're paying no taxes on the gains until you sell it. So if you bought a stock, and some people will hang on to it for like 20 years, and it's increased in value, and they receive dividends, and they have to pay taxes on the dividends, but not the increase in price that it's been increasing in value. It could have even, we're going to talk about stock splits when you get back from vacation. It could have even split. So they may have started with 100 shares, but if it went through a 2-for-1 split in year 5, now they have 200 shares. Oh, year 10, it went another 2-for-1 split. Now they have 400 shares. 20 years go by, That stock is worth a lot more than it was 20 years ago. You do not pay taxes on any of that until you finally sell it. The year you sell it is the year that you pay taxes for. You pay for the whole gain that year you sold it. That's when the tax takes place. So that's how that works. Some people will hang on. My father hated taxes so much, he would hang on to an investment until he died, and now I gotta pay the taxes. So, and that's how much he hated taxes. People will do that. They'll hang on to something forever just to avoid the tax, and then die and never even enjoy that whole investment they had the whole time. So, we talked about evaluating stocks. We're going to earnings per share. Go to slide 12. Earnings per share. When we were on Yahoo Finance, that's one of the stats right on the main page, earnings per share. If you don't see a number there, usually on Yahoo Finance, that means they are not earning any profits. You go to Tesla, I've never seen an earnings per share for Tesla because they've never made a profit, a yearly profit. They had this one little month maybe, or one little quarter where they, and SEC may be investigating that because they may have inflated their numbers a little bit just so they could show a profit or that they made a certain amount of cars. Tesla's in trouble. Their price went down yesterday. Was it yesterday? No.
I think it was something like yesterday.
Well,
There's another tweet scandal. The SEC wants Elon held.
As soon as the SEC announces they're doing an investigation, a stock price will tumble. Usually 5 to 15%. I don't know how much Tesla went down, but that's the usual case when an SEC announces they're doing any kind of investigation. And a lot of these things, the announcements, they try to do it after the market closes or before it opens, so there isn't a hyper-effective reaction from whatever the news is. You'll see a lot of companies will do what's called their conference calls, where they're reporting how they did for the last 3 months. And you'll see the market react to that very fast. But so a lot of conference calls will take place after the market closes or before it opens or something. So it doesn't have an instant reaction. People can digest it before they react. But earnings per share is, if you took the profit for the whole year of a company and divided that profit, this is after they pay taxes, net profit, and divided by the number of shares that everybody owns, called outstanding shares, that's the earnings per shares. The profit divided by all the number of shares that exist. So, and also on page 398, I like this example. Bottom of the page. Let's get this in. It says, an example of earnings per share. Let's assume General Mills had $1,855,000,000 in earnings, after-tax profit. That's right, there's companies, all kinds of companies out there having $1 billion profit. Also assume that General Mills, the company known for producing consumer build products, has 666 million shares of common stock out there. You take 1,855,000,000 divided by 666 million shares, that's $2.79 earnings per share. That's the whole calculation right there. Yeah, you're going to have an earnings per share calculation in your future. And so, what's the date today? 27th? Okay. So all you got to do is make sure you have this page handy. You pick out the profit, you divide by the number of outstanding shares, you calculate. But this number is used in another calculation, which is, we're on the same slide. Hang on a minute. This is, we're going to price earnings ratio, but it's also at the top of page 399. That earnings per share you just calculated, where is it? Is your denominator. Your numerator is what's the current price that stock is selling for. So in this case, this is Procter & Gamble. Their earnings per share is $3.72. All right. And then right now, if the stock were selling for $82, the price earnings ratio for that would be 22. Now, what does that mean? I wrote down, off the top of my head, I said most price earnings ratios that I'm familiar with are between 6 and 22. But I know it's somewhere in your book here. Here it is. Right here on page 399, it says, a high price earnings ratio is over 20, often indicates investor optimism because of the expectation of higher earnings in the future. hang on. It says, on the other hand, a low price earnings ratio, I'm down here, oh, you see. A low price earnings ratio under 20 indicates the investors have lower earnings expectations. Now, I want to make sure you realize that's not the only interpretation of the PE ratio. Because there's sometimes where I see a low PE ratio, and I know there's other places that announce, let's say this, and it could be showing me that, hey, I see this company turning things around, I see that they're increasing revenues, I see they're increasing profit, they have a low price earnings ratio, that's a buying opportunity. That's what it's telling me, that other investors haven't forced the price up to realize that's a buying opportunity, and I'm grabbing it early enough before other investors have figured it out. So you gotta, you have to look at other things other than just the price earnings ratio, and it could have other interpretations. But this is the most common. And so I said, what did I say, 5 to 22? This one kind of makes it look like it's between something and 20. So it's calling 22 high. I call that almost average, really, in a way. I didn't open up Yahoo, but if anybody has their Yahoo open, just raise your hand when you can tell me when you see, let's do a Netflix or, I'm trying to think of another out of the sky company. I don't know, do Netflix, and we'll see what it is. Remember, average is like 522, so let me know when you have it. How is it calculated? You got that at the top of the page. What is it?
135.
135. Average is between 5 and 22. Netflix is 135. So, as you can see, and yet people still, what it tells me is when you see a PE ratio that high, even though Netflix is doing some things right, obviously, because they still have tons of new members, even after raising prices, which is amazing, that this number tells me that there's a lot of risk buying this stock. I don't have it in front of me. Buying Netflix at whatever price it's at, that it's a lot of risk. But it's been this way for a long time, and it's still this way. So people still have such optimism about Netflix as a company that I must be missing the boat. And that there must be still room for that price to go up to have such a high PE ratio. What? Go ahead.
Something you mentioned before that I was kind of curious of is since different stocks have different priorities on who gets paid first when it comes
No. That's a law. I was just telling you by law. They have to pay off the bondholders first, preferred stockholders second, then common. That's a law.
Yeah.
Yeah, they don't get to pick.
Right.
Okay,
well,
okay.
yeah, that's what I mean. But yes,
It's the same for every company. Everybody's the same. No one can do it differently.
Okay, right. That wasn't
Okay.
my point. I get that. How do you feel about like finding a company that is kind of in danger and is so the price of its stock is really low because people are trying to get out of it, and getting preferred stock with that, or getting something with a high priority for getting paid back if it does go bankrupt, because you could potentially get your money back, but then also make a whole bunch of money if they
It
come
would be
back.
the worst decision ever.
It would be?
The worst decision ever. Don't get me wrong. General Electric was having all kinds of problems in 2009, maybe 2010. There should be all kinds of news articles about it, because this was a big deal. The government was not bailing out General Electric, even though the economy had turned around majorly. Warren Buffett personally came in and did exactly what Luther's asking about, which is a crazy move. When a company's ship is sinking, General Electric had billions of liabilities and billions in assets, but they played it so close to the edge that this economic downfall, the financial crash, and the housing market situation caused the revenue to sink to a point to where, okay, this is turning into a bad situation, and they're going to have money troubles. And Warren Buffett came in and said, look, I'm not going to bail you out by buying common stock. It's just too risky. But he did exactly what you said, Luther. He came in and said, if you'll sell me preferred stock, they had to issue this preferred stock just for him. And he said, and if you make sure I'm getting 10% dividend, I don't remember how much, but I believe it was like $1 billion. He kind of left them as really through buying preferred stock with a guarantee of getting 10%. So it ended up working out. Not only did he get his 10%, he got all his money back within, I think there's news articles on it, somebody could catch it, but it's like 3 or 4 or 5 years. And now General Electric's having problems again. We're now in 9, 10 years later, Warren Buffett's got all his money now, and General Electric's having problems again.
Wait, then why was it a bad idea?
It wasn't. It's the only time I've ever heard it work out.
Oh, okay.
But in most cases, it is a bad idea because the sinking ship, even if it was not $1 billion or whatever amount he used, whoever did it, if they only did like 10 million or something, would have lost all their money. General Electric would not have survived. It would have been probably the largest bankruptcy. Lehman Brothers is our largest bankruptcy in U.S. history. And that's in 2009, I believe, or the end of 2008, something like that. General Electric, I believe, would have been a larger bankruptcy. I'm not positive. But, and there's, you know, they're still possibly having some money troubles right now and asking for some loans or a bailout of some kind. Their stock has really been hurting because people have noticed that things are not going so well.
So what determines how much money they have to
Pay if they do go bankrupt?
Yeah, when they go bankrupt.
As soon as they go bankrupt, if it's not one that's going to reconstruct the company, it's one where it's selling off the assets, the court appoints a trustee. Now, the crazy thing is, anyway, a court appoints a trustee, and the trustee's job is to start selling the assets and writing checks to the liabilities, and then what's left over, make sure that the shareholders get it, the bonds, then the preferred, then the common. A trustee gets appointed to take care of all that. This is what happened in Lehman Brothers. All right? So, price earnings ratio, earnings per share, we got those down. Next, and we saw an example from the book also. Where am I? Okay, forget it. Slide 13. Dividend yield. Now, a dividend yield is only when companies happen to pay a dividend to their common shareholders that you see the dividend yield on that Yahoo Finance. You'll see the stock's dividend yield. But it happens to be on page 400. You can see how it's calculated. It's basically, again, the price of the stock is your numerator, is your denominator. Your numerator is how much the company paid in dividends per share to its shareholders for a year. So some companies will do dividends every 3 months, some will do it every 6 months, and some will only do it once a year. But it's how much did they pay to a shareholder for a whole year. In this example, this company paid $1.92 to each shareholder in a year. The current price of the share is $78. So if you went to Yahoo Finance, for example, and this is truly the price, and this was truly the dividend, you would see dividend yield 2.5%. So it's 0.025, move the decimal 2 places, 2.5%. So that's how it's calculated. If this were on a quiz, you just got to pull out of the story, the question you're being asked, find the price per share, find what the annual dividend is. Be careful. If the dividend says this is how much for every 6 months, you've got to make sure you're using annual dividend here for the numerator. Add up 6 months, or if it's 4 quarters, add up all 4 quarters to get the yearly amount. All right, what was that one? Dividend yield. Now we're going to total return. Total return is just like it was for the mutual funds. You got to add up all the money that was made on this investment in dividends, and then how much was made when you sold it for more than what you bought it for. That's the appreciation part. And you add those up, and that's your total amount made. But you got to take it one step farther. So we're going to go to the bottom of page 400. You got to turn it into a percentage. So in this example, I wrote right next to it how to turn it into a percentage. The example is, this person owned GameStop 100 shares for exactly 1 year. All right, so this percentage is going to be 1 year. And they bought it for $33 a share. 1 year later, they sold it for $40 a share, making a profit. And while they had it, they received $1.32 for each share in dividends during the year. What was the total return in dollars? You would take $1.32 times 100, there's $132. You would take the increase in value, which is $7, 40 minus 33 times 100 shares is $700. The total gain, $832. Now, if this is a quiz question, it'll say, and what was the total return percentage? Take the money made, $832, and divide by the total initial investment. Right here in the story, 100 shares were purchased for $33 a share. There's the initial investment. 33 shares times 100 is $3,300 divided into the amount made for the year. 0.252, move the decimal 2 places, 25.2% gain, return on the investment, which is unbelievable. Now what if this said 2 years, but I'm asking you to calculate the yearly percentage? What would you do for the last step? The camera can't hear anybody. It was all whispers of unsureness. Anybody? If this were for 2 years, and the question says, what is the yearly percent return? What was the last step then? Divide by 2. If this were for 3 years, and it asks for the yearly, divide by 3. If this is for a year and a half, divide by a year and a half. Right? Almost everything you read is giving you the percents per year. Even when you're reading those mutual funds, and you went to the 3-year column, 5-year column, 10-year column, those percentages you're reading is what the average was per year, 1 year, over the last 10 years, over the last 5 years, 3 years. So you got to get used to having all percentages being communicated per year. All right, next, let's see what one was that. That was total return, dollar amount, and percentage. And now, going here. This one, we talked a little bit about it already, but it's book value. I told you when we talked about it that it would be coming. Book value. Book value. And there happens to be an example at the bottom of page 401, but it's the net worth of the company divided by the total outstanding shares, total number of outstanding shares. Okay? Book value of the company is just like our book value that we had back in chapter 1, 2, or 3, or whatever it was. It's all of the company's assets minus all the company's liabilities, and what's left over is the net worth divided by the number of shares. This company has assets of $19,345,000,000 minus liabilities of $12,009,000,000 divided by the number of outstanding shares of 700 million. So the difference here is like $7 billion net worth, 7 billion something million, divided by 700 million, $10.48 per share book value. Now this means, this company says, which company is this? Southwest Airlines. Southwest Airlines says, we're not in financial trouble. We just decided we want to close today. We just want to close. Everybody's laid off. Boom. Stop paying rent. Start selling everything. And all the money they expect to get is going to be $19,345,000,000. And whoever's in charge of rounding up, selling all the assets, are paying off all the liabilities. This isn't investors. This is, we owe our suppliers. We owe for gas. We owe for the employees. You know, we owe them at least 2 weeks payroll. You know, they pay after you work, not before you work. So they pay off all these liabilities. And then they say, here's how much we have left over, 7 billion, million. Now let's split it up to all the shareholders. You have 100 shares, $10.48 times 100. You have 1,000 shares, $10.48 times 1,000. And they send checks out, and that's how much money people would get. But I'm going to tell you, whoever's getting this in no way paid $10.48 for the share they own. Because almost all the shares on the stock market are selling for 4 times, 5 times, 10 times, 15 times book value. Now when you're buying a share of stock, you're not paying what it's really worth. You're paying what investors expect it to become worth later. You're paying for the future. And when you're selling it, you sell it to someone else based on the future. That's how it works. And in the old days, my rule was, I don't want to overpay for a stock, so I would always look at book value, or what's called, now this is not in your PowerPoint, and it's not in your book, but this is the second or third time I'll bring it up, so it could be on your quiz or final. But it is your price to book ratio. Is that on there or not? That's not where up there. Is it on here? No, it's not. Your price to book ratio. In the old days, If the price were 3 times, so if this calculated out to 3, divided the book value divided into the current price, if it equaled 3, that was about the limit that you wanted to pay, 3 times what it was really worth. You know, and if you saw a company selling for 2 times or 1.5 times what the book value was, and yet they're a growing company, you go, wow, here's a good value. But now, it's hard to find a company that is selling for 3 or less times what it's really worth. And it's more like 10 or 15. I know we brought up a couple of them and looked them up. I can't remember what the numbers were, but I know they had to have been up there. God, you guys, you're forcing me now to open up the other. Did we talk about these? The invert that's still, you can't see it. Let me use time. Let me go through all that. Look at, we got invert still going on, you guys, still going on. It's just waiting for the trigger to take everyone's money. Okay. Do we have spring break yet? Okay, well, let's just name something you own. What was one of the ones you owned? What was the makeup one? How's that? I don't know. How do you spell it again? ULTA? UL? Okay, here we go. First of all, you know, beta was on the next item on our list. Let's talk about beta. All right. Would you say this company is more risky or less risky than the average stock market? More is correct. Because it's higher than 1, correct? 1 means that this stock would be going the exact same direction. The ups and downs are almost the exact same, correlating with the overall stock market as an average. What if it was a negative 1.49? Hang on a minute. Let me make sure I say this correctly. If this were negative 1.49 and another company was a positive 1.49, which one would be considered more risky? Hang on now, this is a trick question.
They're both risky.
They're both risky and the same risk. One just happens to be going in inverted direction compared to the overall market. When the overall market goes up, that particular company's stock usually goes the opposite direction, more so as a percentage than whatever amount the average market went. For example, this stock goes in the same direction because it's a positive 1.49, but it's more risky because it's above 1. And it means if the stock market were to go down 3%, this stock would go down 3% plus probably another 50% would be another 1.5%, approximately. At least historically, over the last amount of time, whatever it is that they calculate this, 3 months, over the last 3 months, that is what this particular price of this stock's been doing. The reaction has been going the same direction, but bigger ups and bigger downs. And so you've got to kind of make the assumption, well, if I'm about to buy into it, and I'm looking at a short-term strategy for the next 3 months, this could possibly have bigger ups and downs. Now, if you say, I know this market's about to go up, you want to start jumping in companies that do have high betas, because as soon as that market takes off, the ones with high betas will take off even higher, and that's your kill. That's the one that takes you from 24th place to 12th place. But if you think this market's going down, you might be looking for a negative 1.49. Wow, I think this market's going down here in the next month or so. I'm going to go after, I'm going to take some risk. I'm not in the top 10, I'm in the bottom 10. I'm going to find a negative 1.29 stock, and I'm getting in that one because if this market goes down, that one's heading up even bigger. And that would be my kill. You can use it as a strategy, but beta, I think it's very, it's in your book on page 401 in the little right-hand column. And we've talked about it a lot in this class, so it will be on your quiz or final, one or the other, just so you know. And there's a PE ratio, 28.55. Close to normal, a little above normal, right? And what price is this share selling for? We can't see it. Can you see it? $307.11, all right? $307.11. My question for you, what is this? Ultra. What do you think this price to book ratio is? Do you think it's higher or lower than a 10? How's that? Let me look at the PE ratio again. We've got a 28.55. It's close to normal, just a little above normal. Could be opportunity, we're not sure. What about market cap? Look at this. I can't remember what the number was to determine if it's large cap, mid cap, or small cap, but here is what you'd look at to determine whether it's small, mid, or large. And then you look at the ranges so you know which one it is. But go ahead, give me your guess. Price to book ratio, more or less than 10. I don't know the answer. I'm going to say more, just to get things started. No one else wants to guess. No one else.
15.
You're going, huh?
15.
You're going to guess 15? I appreciate the guess, since no one else is. Okay, I'm going to stats. Now I'm going to look for the book. I don't have to look for a book value because the price to book ratio is right there. Wow. What is it?
9.95.
9.95. I thought it was a little over, I would have guessed over 10. 9.95. There you go. But 3 is unheard of. It will be very hard to find a company that is stock price is only 3 above book value. And I used to say anything above 3 is overpriced. This is like normal. This is almost a 10. So, you know, the stock market is a whole different world than it used to be back in my day. And so it's just that much more risky in my opinion. And you should treat it just as if, I don't know if you've ever gone to a casino, but a lot of people go to a casino and go, look, I'm going to this casino, and if I lose $100, I'm done. Well, that's how you got to look at the stock market. You go into the stock market, let's say with $1,000 or something, only go in with whatever you can afford to lose and not get emotional about it. That's how I look at it. All right? Because it's just that risky these days. Go ahead.
So it's book value divided by price per share?
No, price per share divided by book value. Book value is always lower than the price per share. So that's how many times you're paying above really what it's worth. Is how many times you're paying above. Brian, did you have a question? Someone else had their hand up. Jeff? Or Seth?
Yeah, you can actually filter that out in Yahoo. You can find a specific price to book ratio. So if you,
What do you mean?
you can actually search for companies that have like a below.
Oh, specifically looking, say, show me all the companies that have a price to book ratio of 4 or below
Yeah,
through Yahoo Finance?
yeah.
Well, I like that. We don't have time for that right now, but I like it. Will you send me an email on that? You don't have to. Now that you brought it to my attention, I'll search and find it. But I didn't even dawn on me that it would do something like that. I like it though. It's a great idea. Matter of fact, I don't know if that would work as a short-term strategy because usually that's a long-term tactic. But you know, you guys, anything you can come up with right now to capitalize on this game. Again, transactions seem to be the way to capitalize because you get free money. In some cases, and if you didn't get free money, do another transaction because it's going to happen. It looks like to everybody eventually. But what I fear is going to happen twice. Like it's happened to 2 different ones, but it was on the same day. I can't remember. It was different days even. So you can get the lottery twice, and the luck of that's pretty odd. Okay, is everybody signed in? Because I think I ran out of subjects. All right. If you haven't handed your homework, get it in. Those who are late, stop by here. Let me give you the handbag that I was doing. Everybody signed in, drop that off. Have a great vacation. We'll finish this chapter on Monday when we get back, and then your quiz is on Wednesday.